Welcome students. In this session we will learn how to prepare another very important financial statement, that is the balance sheet. We have learned so far how to prepare the profit and loss account, which has two parts, trading account and profit and loss account, and now we will learn how to prepare the another important financial statement, and that statement is called as balance sheet, right. So, the format of the balance sheet is also like the format of profit and loss account, again T format of the balance sheet, but there are some basic structural differences in preparing the balance sheet as compared to the profit and loss account, and we will talk about that and we will discuss about that, and we will learn how to prepare a very important financial statement, that is the balance sheet, right. So, we will write here first structural difference is the title. So, we will write here balance sheet of Kautilya and Company, as on 31st December 2011. What was the title there? Trading and profit and loss account of a particular company, means the name of the Kautilya and Company for the year ending on 31st December 2011. And now we have put it here, balance sheet of Kautilya and Company as on 31st December 2011. It means that statement, profit and loss account or income statement, is depicting the results of the business for a period of one full year. Whereas the balance sheet is we are writing here as on, it means it depicts the financial position of the business only for one day. So, that statement depicts the financial results of the business for one full year, and this statement depicts the financial position of the business only on one day, that is the last day of the year, last day of the accounting period. Once in a year we check, we prepare the balance sheet and we check that the asset and liability position of the business is equal, is balanced or not. If it is balanced, then fine. If it is not balanced, then we will have to take the corrective measures. Now, when we after this title, again this lower part is also different, and there we were writing particulars and amount and debit and credit. Here we will be writing liabilities and capital, and here it is amount, but no debit and no credit, and this side we write it as assets, but without any debit or credit. So, liabilities and capital and the assets. This side will explain that how much resources the firm has generated from different sources, right. How much funds the firm has generated from the different sources, this side will tell us about that, and how these resources have been used by the firm or are being used by the firm, this side will tell us. So, how much funds we have invested and how much properties we have created out of those funds is to be found out from the asset side. So, both the sides should be equal. Now, for example, we have borrowed any money from the bank, and bank would like to make sure that where that money has gone to. For example, we have taken say 10,000 rupees from the bank to buy a computer. So, that computer bank would like to ensure that yes, that computer is there with you. So, on this side we will show in our own balance sheet the bank loan, and this side will show the computer, and if both the sides are equal, it means I can easily justify that this 10,000 rupees I borrowed from any source, I have purchased the computer. So, my computer and loans are equally comparable to each other. So, I have not misappropriated those funds, and those funds which I have borrowed on the name of the business, they are in the business, they are shown on this side, and they are being say verified by this side, because equal amount of the resources we have invested to have this side of the equal amount of the assets, right. So, when we have this note, and when another important structural difference is we do not use any to or by for preparing this statement. No to on this side, no by on this side. First we will take the capital and then the liabilities, and then we will take all the assets, and then we will see both the sides are equal. That is why since both the sides, and no balance has to be found out, like no profit, no loss, nothing. We have to see that both of the sides are equal. It means both the sides are balanced, both the sides are equal. That is why this statement is called as the balance sheet, which depicts the financial position of the business only on one day on which the balance sheet is prepared. Not before that, not after that. One day before the balance sheet position may be different, one day after the balance sheet position may be different, but on the date of the balance sheet on which the balance sheet is being prepared, you should have a balanced position. So now we will have to find out from this information, these balances, we have to put liabilities and capital this side, and we have to put the all assets this side, right. So normally when we prepare this statement, we prepare this statement in the order of permanence. Order of permanence means that we put the long term assets here, similarly we put the long term liabilities here, and then we go on coming to the lower side which has the short term assets, current assets we call them, and this side we have the current liabilities. So for example, when we talk about the assets or the properties of the business or the liability, we will start from this side. So first and the longest source available with the business is the share capital. So we take here as a share capital is the first thing which we start with. This is the longest source resource available with the firm. So we will have, because the share capital, if it is a company form of organization, share capital invested by the shareholders in the company will be returned back to them only at the time of the closure of the company. Company can buy it back earlier also, but we can return it earlier also, but normally if it is not to be done by the firm, then it has to be paid in the end if the firm is to be closed. So it's the longest, means the liability, a kind of a liability, kind of a resource with the longest duration. Then we take the say long term loans. Here we take the, in this statement we take the long term loans. Then we can take the other sources, long term sources like debentures, and then we take the short term liabilities. Short term liabilities we can take it as a short term loans. Short term loans, which are short term, difference between the long term and short term is any resource raised by the firm which is going to be used by this firm for a period of more than 1 year, having a life of more than 1 year is a long term source, and any resource being used by this firm for fulfilling its funding requirement and having a maximum duration of 1 year is a short term source, right. So debentures are issued normally for more than a 1 year's period of time. Long term loans are also taken normally for more than 1 year's period of time. Share capital is taken for the lifetime of the company. So we are taking the long term liabilities first, then we are talking about the short term liabilities, and short term liabilities, other name of the short term liabilities is the current liabilities. And the short term liabilities, first liability is the short term loans. Then you can have say here sundry creditors. Sundry creditors are the basically suppliers who supply the raw material to the business on the credit basis. They are not being paid by the firm at the point of buying the raw material, they will be paid at the later date. So they are called as the suppliers. Sundry creditors, creditors means who have to take the funds, who have to, the firm to whom the firm have to pay at the later date. So this is also a current liability, who are providing you to the resources, means the raw material without capital, without funds. So it means it is a short term source. Similarly, bills payable. Bills payable is again a liability. So it means bills payable are kind of a creditors, means both are a kind of, this may be the creditor for buying the raw material, this may be creditor for any other thing, maybe we have taken some funds from one firm or something like that. So bills payable and creditors are two again short term liabilities which are only for a few months we take, and then they have to be shown as a, so there means bills payable are also like the sundry creditors. And then we can have some other kind of the current liabilities, maybe any kind of the outstanding expenses. Outstanding expenses. Outstanding expenses means any expense which has become due to be paid by the firm but has not yet been paid. It means this is also a liability. They are also providing, for example, you talk about the salaries of employees. Salary of the employees have become due to be paid, but for the past 2 months the firm has not paid the salaries. Now those salaries where the firm has enjoyed the services of employees, but the salaries have not been paid, so we will put those outstanding salaries in the liabilities column. So this way you can have the long term liabilities, short term liabilities or the current liabilities, and we prepare the balance sheet in the order of permanence. Similarly, now how these resources are being used. Long term resources are generally used for the long term assets, and short term assets resources are generally used for the short term assets, but sometimes the long term funds can be used for the short term requirements also, and the short term funds can be used for the long term requirements also if possible. So here we take the assets, and the first asset we take here is the land. If any land is purchased from these resources by the firm, then that we have to show here as a land. Another is the plant and machinery. Oh sorry, we can take it as the buildings. Buildings is the another important long term asset, buildings. Then we have plant and machinery. Plant and machinery is the another fixed asset. Then any other fixed asset, furniture is another fixed asset. There can be patents, can be another long term assets. So all these are the land, buildings, plant and machinery, furniture, and some fixtures also, sometimes we call it as fixtures. Divisions of the firm, different means making a big hall into, converting a big hall into small rooms, they are called as fixtures, patents. So all these are the long term assets where these funds are invested and the assets are created. Then we come down to like the short term or current liabilities. We have current assets also, and the first current asset is the inventory, is the raw material or inventory of all kinds. Inventory. We have three kind of inventories normally: inventory of raw material, inventory of work in process, and inventory of finished goods. So all the inventories can be put together here, or they can be shown separately: inventory for raw material, inventory for work in process, and inventory of finished goods. Then we have sundry debtors. Here this side we have sundry creditors, and this side we had sundry debtors. So as I told you that who are the sundry creditors? Who give the supplies of raw materials to this firm on the credit basis, to whom this firm has to pay on the later date. Similarly, if the firm is receiving the credit purchases, they are also bound to give the credit sales. It means people will buy from them this firm today, but they will pay the firm at the later date. It means this firm is giving the credit to these people for some period of time. So they are the sundry debtors. Similarly, another item here is a bills payable. So here it is a bills receivable, and this is the bills. This side is a bills receivable. Sometimes is a bills receivable. So they are also kind of the debtors. Bills receivables are also kind of the debtors. So sundry debtors, where we have sold them, they have given the, say we have given them the invoice, they have accepted the invoice, that is we have purchased those goods from you and we will pay you at a later date. So all those people who have to pay at the later date, they are called as sundry debtors. And here we have the bills receivables. Bills receivables is kind of a document which is a legal document. Means when any person or any you can call it as any buyer from the firm, when he buys on the credit and firm wants a proof that we have sold to this firm or to this person on credit, and he will be paying us this much of the amount as a the price of those sales after 2 months period of time or after 3 months period of time. So the firm who is the seller, this firm who is the seller to somebody, this firm will write a document, will prepare a document on the legal judicial paper, and they will write on that we have sold goods worth rupees 50,000 to this person or this company, and this company will pay us a sum of rupees 50,000 after a period of 2 months, and then that document will be sealed and signed by the company who is preparing it, the selling company, and will be given to the legal authorized representative of the buying company or the buying person, and he will put his signature and stamp and will return the document back to the selling company. It means it is a proof that this person who has purchased the goods, he has put his seals and signatures, he has got this bill accepted, and these goods they have purchased and they have to pay at the later date. So this bill is the proof of those credit purchases. So bill receivable is written by the company who is selling the goods to somebody. They have to show it at the time of the goods, they have to give it to the buying company's representative has to sign it and return it back to the selling company will retain this bill till the date of payment, and on the date of payment this bill will be presented by the selling company to buying company, and this buying company will make the payment to the selling company, and then this document will be destroyed. So this is a bills receivable. So this is a bills receivable for the company who has to receive the payment because of the credit sales, and this is the bills payable for the company who has to make the payment against the purchases they have made it today, and they will make the payment after 2 months or 3 months. So this is the bills payable and bills which is a proof of the credit sales made. Similarly, the debtors is also the buyers on credit, so almost one is the same thing. So it means we have taken this inventory, sundry debtors, bills receivables, and then we will take other current assets, like say we have taken the outstanding expenses. So the outstanding expense means any expense which has become due to be paid but has not yet been paid by the firm becomes a outstanding expense, is a liability. Right? Similarly, here this side it can be, that is the advance payments. Advance payments. For example, some material is of a very critical nature and that material is not normally available. So to ensure the supply of that material to this firm by the supplier, this firm makes the advance payment to the supplier, so that he is sure that I have got the payment, now I am bound to supply the material. So sometimes advance payments are made by the firm. So any payment which has been made by the firm today and the benefit of that will be enjoyed by the firm at some future date is called as a asset. Similarly, you have the loans and advances. Loans and advances. Loans and advances, as I told you that we have taken the short term loan. When this firm borrows as a short term loan from bank or any financial institution or any somebody else, then this is called as a liability. But sometimes if they have surplus funds, they can also these funds to give the loan to somebody, and when the loan is given it becomes the asset, when the loan is taken it becomes the liability. Similarly, you can call it as the marketable securities. Marketable securities, and marketable securities are very short term investments. Sometimes we have surplus cash here, we don't want to keep it as a cash, so we can keep that cash as a surplus, and means we can keep that surplus cash, we can invest in the market, and that short term investments are called as marketable securities. Why they are called as marketable? Because at any point of time we can sell these securities in the market and we can get our funds back. Maybe it's a call investments, just on simple call, or it's a overnight investments, weekly investments, fortnightly investments, very short term investments, almost they are also liquid kind of investments, so they can be had. And once all these, other than these current assets, we have two more current assets: cash in hand and cash at bank. Cash in hand and cash at bank. So these are the total, this is the means some of the major items in the balance sheet. Some of the major items in the balance sheet are, we have taken all the resources this side, we have taken all the assets this side, and then we will see that for a company who has raised the resources showing on this side, and whether they have the properties, assets equal to this side or not. If this side is equal to this side, then the balance sheet is balanced, financial position is acceptable, financial position is balanced, and there is no problem in the firm. But if this side is bigger than this side, it means the firm is in a difficult state, because liabilities are more than the assets. And if this side is bigger than this side, then the firm is in a very good state. But normally we don't show that kind of the balance sheet to in general public. We say that our assets, the properties are more than the balance sheet, but somehow we have the different method that we keep it balanced, and that internal stakeholders, they know that what is the internal position of the balance sheet of the firm, but largely that is for the public, that is kept as a balanced. How to keep it balanced, that there are different methods are there, we will discuss sometimes later on. So it means the assets and the liabilities, this assets on this side, liabilities on this side, and at the end of the day this document should be a balanced document, both the sides should be equal, right. Now we will prepare the balance sheet for this company, Kautilya and Company, and we will try to see that what is the total information here, and we have to take that information to the balance sheet. Purchases we have already done, wages we have already done, insurance we have done, sundry debtors. Sundry debtor is 15,000 and 2,250. This is a bills receivable. BR, I told you bills receivable is a proof of the credit sales. 2250 is the bills receivable. Sundry debtors, bills receivables. Then we have carriage inwards is expense we have taken, commission we have taken, interest on capital is expense we have taken, stationery we have taken, return inwards we have taken, commission we have taken. Return outwards we have taken trade expenses, we have taken office fixtures, we have taken cash in hand, cash at bank, rent we have taken, cash, everything we have taken. Now we have one more item, bills payable is, here we have to take the, write this 1500. Bills payable we have, then we have creditors, yes we have also the sundry creditors 9825. Why we call them sundry creditors? Means we have small suppliers. So different suppliers, when their total all the suppliers dues are put together, they are called as sundry creditors. Similarly, we have sold to many people. So we don't show their individual accounts. We have the individual accounts in the ledger, but in the balance sheet we club them together and we bring them under the one heading, one title, that is called as sundry debtors. So small number of the buyers, many number of the buyers, small buyers, when they are put together in one figure in under one heading, they become the sundry debtors. So similarly, we have creditors, and then we have the capital 8950. 8950, and one more item we have to take into the balance sheet is that whatever the profit is earned is shown is earned by the firm, that profit becomes the part of the balance sheet and that profit has to be entered here. So we will add here in the capital, share capital, you will add net profit, and that net profit is say for example, what was the net profit in our case? It was our net profit was 12,600 rupees. So you have to put this in the inner column, 8950 in the inner column, and then it is 12,600 rupees, 21,550 is the total capital amount. Why we add this net profit in the capital? Because whatever the profit we earn, that profit is shared into different parts. One part of the profit is distributed as a dividend to the shareholders, another part of the profit is transferred to the general reserve, some reserve created for the contingencies, any unforeseen expense, and if something is left undistributed for any specific head, then that amount is added in the capital. So whatever the profit we keep on earning and we reinvest that in the business, a kind of reinvestment in the business. So initially we started the business with 8950. After 1 year we earned a profit of 12,600 rupees. So now our total investment of the business has become 21,550. So if there is a profit we will add here, if there is a loss we will subtract here. So profit will keep on increasing the capital, loss will keep on decreasing the capital, and if the capital go on eroding, say decreasing, one day the firm will close. But if the profit, if there is a loss and we are subtracting from the capital, then one day means slowly and steadily that capital will become zero and the firm will be closed. But if it is a profit, we are adding that profit here, and that profit is appreciating the capital, increasing the capital, and business is growing day by day and is improving day by day. So we have taken here items which were available out of the total items I have written here. I have taken the items, almost some of the items here. So we had share capital, we had the profit, we had sundry creditors here 9825, and we had the bills payable for 1,500 rupees. And this side if you talk about, we don't have any land, buildings, plant and machinery, furniture and fixtures. I guess we have the furniture, office fixtures are there for the 500 rupees. So we have taken the office fixtures, we have the bills receivables 2250, then we have the other items, similarly we have the sundry debtors, and then we have the cash in hand. Yes, these two items are there with us, cash in hand and cash at bank. So if we take the cash in hand is 250, cash in hand is 250 and it is 2375 is the cash at bank, 2375. is a cash at bank. And one more item which I have left out is this item, that is a closing stock. Closing stock is also an asset. So, closing stock has two treatments. One you have to take in the trading account where we have already taken this, and second treatment of this will be in the balance sheet. Why we are going to make the double treatment of this particular head, this particular item, I will discuss with you in my next lecture. But any item which is outside this trial balance, if it is given here, it is outside the trial balance, it has to be given the double treatment. So, one treatment we have done in the trading account, second treatment we have to do it in the balance sheet, and then the double entry system for this item will be complete. Why we are giving a double treatment, I will discuss with you in the next class. So, it is cash at bank, and finally we will be taking the closing stock. So, this is the closing stock, and if you take the closing stock, the figure is 12500. So, I think all the items we have taken here, and there is no other item, there is no other balance for this. Say for example, your outstanding expenses, no outstanding expenses are there. So, we will have to omit that. We do not have any short term loans, so we have to remove this. Similarly, we do not have any debentures, so we have to remove this. We have to remove the long term loans, we do not have, and similarly we do not have any long term assets here other than furniture. Furniture we have only 500 rupees worth. So, it is the furniture and fixtures, furniture and fixtures. So, it is 500 rupees. We do not have any inventory also. So, we have not to take that inventory, we have not taken the inventory. So, no inventory is here. We have sundry debtors, we have bills receivables, no other assets other than cash and closing stock. So, we have taken. So, it means we have these only current assets and these only current liabilities. So, if you total both the sides now, your balance sheet will be depicting a good balanced view, that is the total of your current assets and current liabilities will be 895. So, it is 21,550, 9825, and then is 1500. So, total of this side becomes 32,875. It means we have raised the resources worth rupees 32,875, and we are justifying that this total 32,875 has gone where we have purchased furniture for 500 rupees. We have made the credit sales and invested 15,000 rupees there. Similarly, we have sold another amount of 2,250 rupees worth. We have cash with us 250 rupees, cash at bank is 2375, and what are the purchases we have made and the sales we have to make tomorrow in the market, out of the total finished goods worth rupees 12,500 rupees, they are with us. So, these are the properties, these are the total resources. If you total up this side, this will also become as the equal to the 32875. So, it is office fixture 500, then it is the sundry debtors, then it is 2250, closing stock we have taken, and then cash in hand, cash at bank. So, it is 32,875 is this. So, it means if you look at this document, this is presenting a balanced view. Your total of this side is equal to the total of this side, and both are equal, both are balanced, and it means the financial position of this business is balanced, financial state of this firm is balanced, and whatever the resources they have raised, they have the proper justification for that, and that is why this document is called as the balance sheet. Now, as I told you that this item we have given the double treatment. Why we have given the double treatment? Once we have taken in the trading account, and second we have taken it in the balance sheet. Why we have given the double treatment to this item, particularly only this item, not all these items. This we have given the double treatment. Why? That I will discuss with you in the next lecture. Thank you very much.